So hello everyone, welcome to today's IEEE Young Professionals webinar on personal finance. This is part 3 of our series presented today by Stacey, who is a personal financial planner. And so my name is Mario Milicevic. I'll be the host of your webinar today. I'm the chair of the Global IEEE Young Professionals Committee. And normally we have Matthew running these webinars, but he's away this week, so I'll be taking over the role for today. Young professionals, we're hosting many monthly webinars in 2015 on different topics like communication, leadership. We'll be introducing some technical, entrepreneurially flavored webinars coming your way as we launch our new entrepreneurship program. So please do look out for those later in the coming months this year. So as an audience member, we do want you to participate. So we kindly ask that you type in any questions you might have into the Q&A box under your webinar. And so you can actually even vote for questions that appear there, and we will have a 5 to 10 minute Q&A session right at the end of the webinar. So I want to introduce today a new initiative that we're starting within the IEEE Young Professionals program. These are these free meetup events that we're holding at global conferences. And really, this is really geared at IEEE members all around the world. So what we're doing is in many of the regions, we have big flagship conferences that attract thousands of members. And so we really want to give our local members the opportunity to network with international participants at these large global conferences. So what we're doing is we're working with the local young professional affinity groups in each of the different regions and cities, especially, to co-host meetup events during large global conferences. So already this year, we had the Austin team run a small meetup during the South by Southwest Festival. There was a large 400-person meetup and mixer at the International Microwave Symposium in Phoenix a couple of weeks ago. Similarly, in Ottawa, in Canada, during the IHTC, the International Humanitarian Technology Conference, there was a panel discussion and young professional mixer. So those are the ones that have happened, and we're looking forward to many new exciting events this year. Happening later this year in Honduras during CONCAPAN, there will be a Young Professionals meetup, again for free. And later this year in Europe, we've got the IoT World Forum in Milan in December, and also the Web Summit in Dublin. So look out for those in November, and then, or actually in December and November. And then later in Region 10, we have the 10Con. So you can definitely go check that out. There will be a meetup event for free for IEEE members. And so we do ask you to stay connected with us. We've got these new career services, Mentor Center and Resume Lab, which will allow you to really take your career to the next level. Find the mentorship that you need to go to the next stage in your career, and polish up your resume, and then take some online modules for answering questions during interviews, just to practice. And so you can find all the announcements about our program through our social media websites, and also our main website. And if you have any questions, please email us at young-professionals@ieee.org. So our webinar today is presented by Stacey, and this is, again, as we mentioned, this is part 3 of our personal finance series. And so today you're going to learn about how you can make smart choices early on in your life, and how to build wealth, and what kind of tips that for success that you could pursue to enjoy that financial success later on in your life. So here we go, Stacey. Whenever you're ready, please take it away.
Thank you, Mario. Hi, everyone. I'm glad you can join me today on this session. In the past 2 sessions, I've talked a lot about saving strategies and the importance of saving and accumulating wealth. And I thought, today I'll put a different spin on it, in the sense that, I think those of you who have been listening, you understand that savings is important. But today I want to talk about risk associated with investing, right? Because a lot of us, we vaguely understand, investing could be risky, but we don't really understand what that means. So I thought, what a great topic for today, especially given what's been happening in the markets recently with Greece, and the markets really haven't been doing very well. I thought it'd be a very timely discussion. So before we get into all of that, though, I just wanted to share 2 concepts with you. I've had these questions, the clients have asked me these questions in the past few weeks, and I thought, you know what, I'm going to just kind of cover this before we get into the concept of risk and investing. So a lot of us at different times in our lives, we have sort of like small amounts of money that comes to us, right? So let's say you file your tax return, you have $1,000 of a tax refund, or you just had your birthday and your grandma gave you $1,000. And so the question that I get is, what do I do with this $1,000? Because it doesn't seem like a lot, and your first reaction would be to spend it. But let me show you how small amounts of money can make a huge difference in your financial life. So, for example, if you have a credit card right now, let's say it's sitting at $1,200 in balance and at 19% interest. If you're just paying the minimum payments on a month-to-month basis, that's going to take you about 11 years to pay it off, and the interest alone will be another $1,100. So really, over that course of 11 years, your interest is the same as the initial amount that you owed, right? So I think this is a pretty clear one. I think it's an easy one. But if I apply the same concept to your mortgage, a lot of us are going to own homes and we're going to have a mortgage. So let's see how this affects your debt when you have a mortgage. So let's say your mortgage is $180,000 and the interest rate is 5%. I mean, right now it is lower than 5%. It's 3%, or actually lower than that. But that's not to say interest rates won't rise, right? So let's say I use a 5% interest rate, and if your monthly payment's about $1,000, it'll take you 25 years to pay it off. Right? The typical mortgage term. The interest you would have paid over the years would be $135,000. Okay, those are big numbers. But let's say you have this $1,000 every year that you put it towards your mortgage every year. So let's say you file your taxes, you have $1,000 in refund, and you do this every year. The interest saved over the term of the mortgage will be $20,000, and you'll be mortgage-free 3 years sooner. So you see how small amounts of money can make a big difference over a longer term, right? So I thought I'd share that with you because I had a lot of people ask me these questions on these small amounts of money and what should you do with it. And I guess the general idea is that if you have debt, use this money towards the debt. If you had a bigger sum, let's say a bonus from work, sudden inheritance or something, let's say in the $10,000 range, then you're better off paying part of it to the loan, but a lot of it towards investing, right? And what I mean by that is, I want to kind of just bring your attention to this rule of thumb, this 72 divided by interest rate. Some of you may have heard of it, but it basically tells you how long it'll take to double your money. So let's say you're investing in the markets and it's generating you 6% return on average, right? So it's not an unreasonable return to assume. So 72 divided by 6 will be 12, so it'll take you 12 years to double your money. So the $10,000 that you invested today, it'll be $20,000 in 12 years. That's also a very powerful concept as well, right? So you see how you're investing and what your investment return is so important. If you're at 2% or 1% at the banks, well, I think you can do the math on how long it'll take to double your money, right? So this is a powerful concept as well. Okay, so I'm going to switch gears now. I know that was a little bit off topic, but thought I'd share that with you. Today it's all about risk, right? Risk in investment. And the question that I ask is, what is risk, right? Do you understand what it means to have a risky portfolio or to have a safe portfolio? Well, we measure risk in 3 different ways, right? One is how your assets are allocated. 2, the amount you're willing to lose, and the probability that you'll reach your retirement goals. And we're going to go through each of them in detail. And a lot of us, I find, we confuse the concept between risk and uncertainty. A lot of us think that they mean the same thing, but actually they're quite different. Uncertainty means you don't know where things are going, right? Uncertainty will always be there. For example, where the markets are headed, we don't know. That's an uncertain concept. But risk means you understand the range of outcomes in your investment portfolio. You know how much is going to go up and how much is going to go down approximately, right? So risk comes in different forms, right? One is the potential loss of capital. So there's always a chance that you invest your money and it goes to zero. There's inflation risk, so you're losing purchasing power if your investments are too safe. So the first one is too risky, the second one is being too safe, and the third is a lack of diversification. So if you have a preference for a certain stock or a certain geographic location, that's being too risky. A survey that was done by Scotiabank, I believe in 2013, they found that only 28% of Canadians own assets outside of Canada. That's kind of scary, actually. And I can understand this behavior because we are in Canada. We understand the stocks in Canada, and we don't understand what we're buying outside of the country. So we naturally assume that whatever is outside of Canada or the U.S. is risky. But focusing on just one geographic location is really just as risky. The other thing that I see also is, sometimes you're overly attached to a certain stock or a certain company. So, for example, let's say your dad works in RIM or works at Manulife, and so you think you have some kind of a special insight into the company, or you have a certain attachment to the company, and so therefore you tend to overbuy in a certain stock, right? And we saw this with Nortel. Some of you are probably familiar with Nortel. It's one of those too big to fail companies, kind of like the Titanic of investments. We think, well, Titanic, it's too big to fail. Same thing with Nortel, right? And I've seen people pour their life savings into one stock to have it go down to zero. So that's a very costly mistake. So a properly diversified portfolio actually needs a minimum of 20 to 30 stocks, preferably more. But having less than 20 or 30, you're not properly diversified. And a lot of us, we think that, okay, we do the research, we have special knowledge. We have knowledge that other people don't know. Well, by the time you heard the information, whether on the news or wherever, that information would have already been priced in the stock. So you're simply chasing the past returns, right? And not to say that you're not going to be a good individual stock picker, but I'm just saying in general, as a general investor, this is what I find. A good tip when you're entering the stock market or when you're entering the investment market is to hold both stocks and bonds. What I mean by that is bonds are things that are giving you dividend income, interest income, and they are not there in your portfolio to outperform stocks, right? Because stocks will naturally outperform. They are in your portfolio to reduce the risk, to reduce what they call volatility, to provide a safety net when the market's tight. So you saw this in 2008, 2009. So that was the financial crisis. And so if you remember, 2008, markets around the world fell, right? This is not just Canada. This really was around the world. And a lot of the investments fell by more than half. But at that same time, government bonds rose sharply, right, to offset those losses. That's why you need bonds in your portfolio, because what's not to say that there's going to be another market crash next year or 2 years from today. Benjamin Graham, if you know the person, you probably do, and Warren Buffett learned from him. And he puts it this way: no portfolio should ever have more than 75% in stocks or less than 25% in stocks. Right? So he believes in, of course, having enough stocks and for it to grow, but also at the same time not overexpose yourself. I find this is an idea that very few investors seem to understand, which is combining risky assets together. So sometimes we think, if we have 10 different risky assets in the portfolio, doesn't the portfolio get more risky? Not really, actually, because when you're investing, you don't look at assets in isolation. You look at them as a whole portfolio. So when you're combining risky assets together, the overall risk of the portfolio actually goes down. So for example, emerging markets, a lot of us consider that to be a very risky segment of the investment world. But if you combine them to another, to bonds or to Canada, to different geographic location, it can actually reduce the risk. And the reason being is a lot of the investments, they move in opposite directions. So what you want is an investment portfolio with stocks that move in opposite directions. What I mean by that is when one stock goes up, the other one preferably goes down. If you have a portfolio of 20 stocks and they're all in oil, they're all going to go up or down at the same time, right? So you're not diversifying your portfolio. So you need some in the financial sector, some in oil, telecommunications. So they all move in different directions, and therefore you're balancing out the risk in your portfolio, right? Here's another risk that I noticed. It's called behavior risk, and it sounds kind of funny and psychology based, but it's actually true. So today we live in such a connected world, right? With social media, we check our news all the time on our phones. And so can we have really information overload? We actually can. So studies have shown that the more people pay attention to the market's up and downs, the more risk averse we become. So the less risky we become as investors. That doesn't mean it's a good thing, right? So Business News Network, CNBC, they're constantly providing information on market updates. How are the stock markets doing? How are the companies doing? That's too much information, and a lot of the information is accurate, and some are inaccurate as well. So the more you see, company price going up and down, the more likely you're to do something foolish, right? Because you're reacting to everyday news versus looking at it long term. And so a key to investing properly in the markets is to understand your own risk profile. So knowing how much risk can you take, and how you determine that is how much risk you can take depends on the time horizon and your income stability. So let's say you are very young today, you're in your 20s or early 30s. That means you can afford to take a lot of risk in your portfolio, right? Because if the markets go down, that's okay. You're only in your 20s or 30s. You have the time to live out that market crash. The older you are, obviously, the less risk you should take. Now, the more secure your job is, the more risk you can take. And I think that's pretty straightforward, right? Because your income is not fluctuating, so you can afford to take a lot more risk. So we have to keep in mind that investing is really a means to an end. You need to know where you want to end up in terms of your asset size to fund your retirement. So if you know this, you can then make better investing decisions, and you're less prone to make silly mistakes throughout the time period, right? A rule of thumb to remember is a 65-year-old should technically have about 30 times the required annual income. So let's say you determine that you can live off of $35,000 a year. So after taxes, net $35,000 to you. That means your portfolio needs to be about $1 million. Once you know this, you can work backwards on how much investment return you need, right? And my recommendation has always been, if you're the average investor, find out how much you need at retirement using this 30-time rule, and then leave your investments alone, and then go to sleep for 40 years, right? That's the ideal way of doing it. Is you create a portfolio, or you have your financial advisor create a portfolio depending on your risk, and just let it be. Because over the course of a lifetime, you're looking at an average return of 5 or 6%, right? Which is a good rate to assume. And why do I say put it in and then go to sleep? I'm going to show you this chart again. I believe I've covered this chart before, but I just think this is such a powerful concept. So if you look at a large stock, let's say the red square, in 1997, the stock's at 33%. 1998, 29, and just follow it. So 1999, 21, minus 9, minus 12, minus 22. Look at 2008, minus 37. And then look at bonds. You see the short bonds, that orange square in 2008, it's 5%. This is what I meant by the stocks are doing minus 40, minus 50, and bonds are doing plus, on the plus side. Or even if it's minus, it's very small. Look at the long bonds, the light blue square in 2008, plus 8%. See what I mean by having both bonds and stocks in your portfolio? That you saw that in 2008, and you will see that again in the future. So back to this red square, right? How are you going to know where is the next, how are you going to know where 2012, 2013, 2014 is going to be for the red square? You don't. And you choose the same square, you choose a different square in any of the years, and you see this wave of a pattern. You'll never know where it's going to be. But if I look at, let's say, look at the most right column, that thing that says last 20 years, look at the average, the middle of the chart. On average, stocks did 10, 9, 8%. Bonds did 6, 5, 7, 8%. So that's what I mean. You're going to assume that you're going to be in the average. And so never mind the crazy minus years and the crazy plus years, because on average, it's going to balance out. This was the investment return over 20 years. If you take the same data for 40 years, it's the same thing. It never fails. It's always that average. So that's what you're going to assume. That's why I say, find your risk, your risk level, invest in all of these sectors, and then just go to sleep, right? So switching gears a little bit in terms of, I talk about, okay, this 30 times rule. So how much do you really need to save? Here's how we look at it. So the first column is the annual retirement income needed, right? For basic necessities in Canada, it's about $28,000, and this is what I mean by after taxes, after everything. This is net cash to you. If you want an average middle class for yourself, it's about $39,000, and then upper middle is $50,000, and then what I call deluxe is about $75,000. You're going to get some of that money from the government, right? Because you've been contributing to Canada Pension Plan. There's older security, although I do have doubts about older security. I don't think it'll be there, but let's say for argument's sake, on average, the government is going to give you about $12,000. So assuming you've worked your entire life until age 65, you need about $12,000 from the government. So that means you're short, right? The difference you have to come up with yourself. And so look at the last three columns is how much of a portfolio size do you need at different ages, right? If you want to retire early, let's say at 60, let's just look at average middle class retirement. You need about $800,000 in portfolio assets. If it's 65, about 650, and at 67, 520. So if you are short, obviously you're gonna have to work a little bit longer. But if you're looking at a portfolio about 800,000 to 1.2 million, you're in a good range for middle class retirement, right? And that's what you should be aiming for. A question that I always get from people is, should I start early to save, or should I, I have a home now, should I pay off my mortgage and then save aggressively after the mortgage? So I did a comparison for you on the two different concepts, two different methods, and let's see which one is better. So let's say right now your annual salary ranges from $50,000 to $120,000. I think it's a good number to assume. If you start early, you don't have to save as much. So let's say you only save 10% of your income. That's $5,000, right? If we look at the $50,000 mark. If you put this money into the RSP, you're going to get an RSP refund. That's $1,500 in refund. If you do this every year until you're 64 years old, well, after 35 years, assuming 3% real return. So real return, what I mean by that is if the investment is giving you 6% return and inflation is 3%, your real return is only 3%, right? Inflation right now is about 2%, so and if your investment return is 6%, that means your real return is 4%. Okay, so let's say for argument's sake 3%. That means your portfolio needs to be about your portfolio is going to be about $390,000 if you do this every year. That's starting early, right? If let's say I don't feel like saving, I cannot save, I'm going to aggressively pay off my mortgage, and then I'm going to save after the mortgage is paid off. Well, at that time you should probably save at least 20%, right? Because you're starting much later. So let's say you did 10,000. So now I'm looking at the second orange table. 10,000, because 20% of 50,000 is 10,000, right? Your tax refund is about 3,000. After 35 years, it amounts to 350. So if I look at the last column, the savings after 35 years, the mortgage option, paying off mortgage and then aggressively saving does come out less, right? So it loses. So I don't recommend. I have never been a fan of, I'll spend and have a great life now and then save aggressively later, because you don't know what's going to happen to you later. Maybe later you want to start a business. Maybe later you fell sick. Something happened to you and you cannot save. I'm a big fan of save when you can, as little as it can be, because it can do wonders over time. And just from a numbers perspective, I hope I convinced you in that sense too, that starting early does pay off a lot more, right? And that's it about for today. I didn't want to go into too much detail and overwhelm you, but I thought this was a very timely topic about the concept of risk, right? Because given what's happening in the market. But I'm opening up the floor to questions. Hopefully you enjoy the session.
Thanks, Stacey. That was very informative. And there have been a couple of questions that have come in, and I have one question that I'd like to start off with, and then I'll jump to the other questions. But I had a question about that, investing over 20 years model that you had, and you had that big chart.
Oh, yes.
or over 40 years, let's say.
Mhm.
Now, what happens if a company, if your portfolio, you have a diverse portfolio, but
Mhm.
but a company or two in your portfolio goes bankrupt? What
Right.
happens then? Or what happens if some of the bonds that you have in your portfolio are no longer offered? How does it work then?
Yeah, and I mean, if the company does go bankrupt, then your investment technically goes to zero, right? Because that company no longer exists. So you've seen sometimes, let's say you invest in a stock and it starts at $35 and then at 20 and then 5 and literally it goes to zero. And so that's why I say, and it does happen because with Nortel, that's exactly what happened, right? And so you need to, and these companies, when they're in the process of going bankrupt, they have to pay their creditors first. And so you're not as an investor, you're not in a great position. And that's why I say, you know what, you've got to have both bonds and stocks and different kinds of stocks as well, right? But essentially, yeah, when that situation does happen, your investments do go to technically zero.
And is there any way that bonds can get taken out of the market, or a bond would no longer be offered? And what happens then?
Well, it does happen, but so let's say when you're investing in a bond, you're actually investing in a company that issued a bond or a government bond. So in the case of a government bond, that most likely will not go away because it's the government, right? It's very secure. You're investing in the Canadian government or whichever country you're in. If you're investing in a company bond, they're going to try really really hard to fulfill so when it's a contract. When you're investing in a bond, they have to pay that money back to you. So unless the company goes bankrupt, that bond will be there because they've got to pay their dividend, they've got to pay their interest income to you. So a bond is like you're loaning money to the corporation, and that company is in return paying you an interest income. So if they just suddenly take the bond away, that's like saying the company is not doing well financially, right? And so most likely, if you're investing in a good company, you've done the research, it's going to be there because they have an obligation to pay you the interest and the principal back to you.
So in that case, bonds are considered much safer. Is there any example of a risky bond? Does that exist?
They do. They're called junk bonds. They are risky.
It's like
So
the Wolf of Wall Street.
that's right, exactly. So that's exactly it. So there definitely are risky bonds, and the returns are obviously a lot higher, but at the same time, it can go bankrupt very quickly as well. So yes, definitely there is. So you're right. So I can't just say bonds are safe, period. But as an average investor, you're in the average market. The bonds there are most likely safe. Well, they're safer, right? But definitely there are bonds that are risky as well.
Right. And you spoke a lot about diversification and investing in multiple industries, multiple sectors, and then geographically around the world. Are
Mhm.
there any places that are sort of you should avoid, or any places where you should definitely have at least one investment, kind of looking geographically?
Mhm. That's an excellent question. I think being in North America, I think being in Canada and U.S. obviously makes a lot of sense, and because the nature of our markets, it is relatively stable compared to the rest of the world, right? But I do think that a lot of us don't invest enough in the global sector. So even in the emerging markets, right, like Brazil or in Asia as well, I think there's huge opportunities there that we're not taking advantage of. In terms of what to avoid, I mean, I think in general, the idea is if you don't really understand the market at all, you should probably avoid it. Or that goes with the investments too. If you don't understand what you're investing in, you don't know what this is about, then you probably shouldn't invest in it. Um, it I don't know if that answered your question, but definitely in terms of looking abroad, you've got to be in some of the. A lot of people have negativity towards emerging markets because they don't know where it's going and it is quite risky. But there's tremendous opportunities there, and I think it's a mistake not to go global that way.
Perfect, perfect. Yeah, because one of the things that I'm concerned about, if my background is in electrical engineering, just like many IEEE members,
Right.
how am I supposed to know um, more about healthcare, or more about oil, or more about other industries? I mean, does it just come down to reading, or does it come down to having a good financial planner as well?
Right. So that could go two ways, right? So if you so as an investor, if you're really interested or if you're really interested in learning about I want to do my own research, I want to invest myself, I want to understand the companies, then you probably don't you're not in need of a financial advisor. You can do that on your own. Granted, it does take a lot of time, but if you have interest in it, then great. But I find most average investors, don't have the time or the energy or the expertise, quite frankly, to do it. And so, yes, they work with a financial advisor who then does all that research for you. If you're, interested in learning more on your own, just even if you work with a financial advisor, you want to know more. Um, Sort of read up on the general. What I mean by that is, let's say, don't read specific. Don't start with a specific health company. Read about the general healthcare industry. Right. Understand the global, the big idea first, and then go down to the basics. Right. So understand the oil industry. How has it been affected in the past couple of months? Right. Understand that first, and then go down to the specifics. But a lot of this work are done by the financial advisor and the portfolio managers, right? That's their job. So you see these funds, they have billions of dollars in them. It's not the financial advisor that's researching them. It's the portfolio manager and their team, right? So a lot of the work is already taken care of, essentially.
Right.
Mhm.
Perfect. Thank you very much for clarifying all that and for a very, very informative presentation.
Absolutely.
Um, awesome. I'd like to thank you, and we're looking forward to part four, date and time to be announced, but I'm sure it'll be just as exciting. So getting ready to conclude here. Um, so I'd like to thank everyone for participating in today's webinar. We will be sending out a feedback survey, so please, if you can just take 2-3 minutes to complete that, it would really help us out to figure out, what's interesting for you and what topics do you want to see on our webinar series. Our next webinar is actually next week, July 13th, at 11 a.m. Eastern Time, and this will be the Humans of IEEE. So many exciting stories about the people that make IEEE happen, the volunteers all around the world, and definitely looking forward to that one. So I do remind you to go check out our career-based services for young professionals, Mentor Center, and Resume Lab. And if you do have any suggestions for us, please do reach out to us online and by email. I'd like to remind you that Young Professionals is really there to empower your early career development, and we want to help you achieve the greatest success that you can as an early career professional. So I'd like to thank you once again for watching, and we look forward to having you at our next webinar. Thank you.